Welcome to the Money Metaphors podcast with your host, Jason Coddington. Jason, good to be with you again. What's on the table for today?
Acronyms. We got
Acronyms.
acronyms today. So in our industry, there's no shortage of acronyms. We got ETFs, we got ACH,
FINRA,
all yes,
CFP, all those things.
all of it, Gap, EBITDA, all of those different. Yeah. So we're gonna talk about a couple things about simplicity and financial planning, and about this other crazy thing about the fear of missing out, or FOMO in this particular
FOMO, lots of
case.
FOMO these days. Yes,
Yes,
very
yes.
much so.
So KISS and FOMO. We'll talk about that, but I'm going to start out with another one that I learned about recently, and I'll give credit to in the show notes. But it's this acronym called VUCA, and it was through a
VUCA.
management. Yeah, and
I don't know that one. That's
it
a
doesn't.
new one
Yeah,
for me.
so it has to deal with organizational decision making, and I'll give credit to the source in the show notes. But it's an acronym, stands for V is for volatility. U is for uncertainty. C is for complexity, and A is for ambiguity. So, and when you have those four in place, you typically have a lack of decision making, or you have friction in decision making. And so, well, what does finance have? They have all of it, right? They have volatility in the markets. We have of course we have uncertainty. No one's predicting 2020 with COVID, the great financial collapse. There are a few people that had that coming, but not in the degree and shape that which it fell. And then of course global things like invasions and stuff like that. So
Right.
the certainty of uncertainty. And then obviously we have complex products. I mean, if you happen to scroll through your TV channel and the financial news has been on, those screens are just intimidating, right? I mean, all the numbers and all the charts and and the options
Everything running
trading.
across the bottom of the screen. Yeah.
Yeah. And then of course ambiguity. You're sitting there watching, maybe a show, and all of a sudden some random guy comes on and says, you should buy gold because the world's ending, and those kinds of things. And so it
happens on
just,
my radio all the time.
yeah, right. I mean, and so how in the world so again, the key point of the whole point of this conversation today is there can be simplicity in financial planning. And you can avoid the fear of missing out in financial planning, but most importantly is to have a plan, even if it's a one-page written plan on a legal pad. You having it written down, having an idea, you can avoid some of the pitfalls. So that is what we're going to do today. Just talk a few things about keeping finance simple. Not on everything, but like we're not going to get simplified taxation, because it's the tax code alone is over 3 million words. So I think we're not doing that, but we will talk about some simple things you can do in your own finances, and then just some ways to avoid the FOMO. So yeah, so we'll go from there. So to start off with the key, the KISS, keep it super simple.
That's a nice way to put it.
More
Yeah,
politically
sure.
correct. Yes. Is we're going to start with retirement accounts, because I think that's where, if you're working for someone and you have a 401k or a retirement plan, typically that's available. It's more common. I've been doing this 28 years. It's far more common now than it was 28 years ago.
Yeah, true.
And so it seems like everybody has access. Not everybody, but many people have access. In California, you're pretty much, if you have employees more than if you work for a place that has more than 5 employees, you have to have one. So your employer has to have one for you. So unless you're exempt from a certain industry, but for the most part, so they're out there. Long story about retirement plans. But what's nice about those is that the money can come right out of your check. So that's simple. That's automated.
You don't even see it. It's like it doesn't exist almost.
Yeah, comes right out of your check, payroll deduction. So that's nice. We've talked about this. I think we talked about the 10-4 rule before, but 10% of your, if you're a 30-year-old saving 10% of your income in retirement for retirement, you have a high probability that you'll have enough resources to live on when you do actually retire or transition to retirement. So that's nice. the other thing that's important is the leverage that exists with a 401k should your employer offer a match plan. So
Mm.
typically that's becoming more common now. So you put in, typically they're running anywhere from 3 to 5%. So if you put in 3% of your pay, your employer would put in, could put in possibly 3% of your pay as well. So you're getting a dollar for dollar match. Um, hard to
Hard to
beat
beat
those
that.
returns.
I was
Hard to
going to
beat
say
that.
that,
So
man,
yeah,
that's better than dividend reinvesting.
yes, that's really good. And so then that leads us to, okay, well, what in the world do I invest in once it's in the 401k? And that also can be simplified. And so, I remember my first job out of college, I worked for Farm Credit, great place. They had a
Mm.
401k plan, and they had, probably 40 different choices, emerging markets, small cap, large cap,
Oh yeah, yeah.
international, all of that. And you would piece together what, and I had fun with that, but, just analytic at the time. And, you put those all together, and you end up, I forget what my contributions are, but let's say it was, $200 a month. I'm carving up $200 amongst 5 different positions, or 7 different positions. Does it need to be that, crazy? And so now what's nice is a lot of these big firms, Fidelity, Vanguard, American funds, most retirement plans have what's called a target date fund or a target risk fund. And
Mm.
so in one fund, you can get 50 different choices, 50 different, not probably exaggerating there, but you can get up to, 10, 20, 30 different allocations within that fund, and you're buying one position. And so, they're called target dates. So, and how those work are, let's say you're 30 years old in 2024 and you want to retire at 65, then you would buy, the 2055 retirement fund, right? So they're typically in ages in increments of ends in 0 or 5. So
Yeah.
2055, 2060, which is not too far away, but seems hard to say. Anyway, so those retirement plans they're so again 10% right out of the chute, and then when you choose it, choose the age weighted, the retirement allocation, and then later on when you build up a large enough balance, maybe if you want to carve that out, work with an advisor and figure out what might make sense, you can do that. But I can say I have clients that have they're in their 50s that have their entire assets in a target date fund, and I don't, you know, I don't see that as a problem.
Yeah. Yeah.
For them it works, and for their financial plan it works. So, it's just a tool that's
It's a
available.
bigger problem if it's not there. The
Right,
fact that it's there is
right.
great. Yeah.
And we'll talk about this whole fear of missing out thing in a second, because people like to go in their 401ks and predict what, and we're just going to tell you not to do that. So keep it simple by put the money in there, have it allocated, and then kind of don't mess with it.
Yeah.
The Ron Popeil method of investing, right? Ron Popeil, with the years, people are not going to remember this if they're under 30, but he was the one that had the gadgets and
Really simple gadgets. Yes.
yes, and it's the set it and forget it method, right? So
Yeah.
that was an oven of some sort that he had, and so anyway, we'll give credit out to him. But anyway, we use that in investing is the set it and vet it, the set it and forget it method for investing does work. If and the point there is not to not look at your account. That's not what we're saying. We're just saying stay invested. So
Yeah.
and
No, no,
then
no. And it is worth, sort of re-emphasizing here. A lot of people when they first start their 401ks, or when they've got their work account and they're asked to make investment choices, it can be really, really overwhelming for a lot of people. This is a way to keep it super simple. And
yeah.
you are putting in your money, you're making your investment, and it is a credible, legitimate way to invest in the markets.
Yeah, yeah. And you take advantage of, the kind of the 3 great things with those target date funds.
Yeah.
You have rebalancing, you have diversification, you have, and you have allocation, which is good. And you have professional management, you have,
Hmm.
so that's all good in one position. So that's nice. So start with the retirement plans. The next place we'll carve out, and you're gonna, I'm gonna basically cutting up paychecks today. I'm reducing them by this conversation, but it does allow for simplification, and along with simplification is automation. I think they're synonymous when it comes to finance. And the next would be after you save that money and you get your net check, have 10% of it saved into a cash reserve. So if you don't already have that, and what we're trying to do there, and the simplification here is life's going to throw you curveballs, right? You're going to have that. We have an oven. We had a power outage and our oven's motherboard, just blew up, right?
Blew up. Yeah. Yeah.
Yeah. And so now it doesn't
Been there,
heat.
done that.
Some of the, not blew up, but in the sense, but like it just doesn't work. Like the motherboard's gone. And so
Yeah.
the burners don't come on, the stove doesn't go on, and when you, and it always happens at the most, inappropriate time, right? My wife's, looking to bake cookies for, an event and no oven. So we got to, call an audible there. So life throws you curveballs. So, lucky enough, it was a quick fix there. Not too expensive, but the nice thing about having a cash reserve is we were able to pay for that.
Like, bam, taken care of.
Not having to go put it, going to credit card debt for that, just able to. And so we're advocating for people to have their cash reserve. And what COVID exposed, and I probably have mentioned this in previous episodes, is what COVID exposed is, when there was a lot of unemployment, a lot of layoffs, I believe the statistic was 56% of families didn't have more than 1 month of living needs saved. And so, we really want to advocate for that. For young individuals, we say that. So just as you have money go into your 401k and get the match, have a direct deposit set up and have your money go to savings for those rainy day funds, because life's going to definitely throw you curveballs. Things are going to break, tires are going to go flat, brakes are going to go out.
Oh, they're going to happen.
Yeah,
And you can't, and to the notion of the certainty of uncertainty, you don't know what it's going to be, but something's going to go.
And I think, and we've used, I don't know if we've used this example before, but, we look at it, that first example, think of your 401k as long-term 401k. Those are long-term assets. That's your castle. And think of the cash reserve around that castle as your moat to that castle.
Makes sense. Yeah.
So yeah, the two simple things. Got my 10% going to savings for cash reserves. And then before that money comes out, going to my employer retirement plan with dollar for dollar match, not a bad thing. And we'll have a spreadsheet in here that helps you go through a decision tree of how much you should or shouldn't do based upon what, whether you have a cash reserve or not, how to optimize your 401k. So it's kind of a nice decision tree to think through. So, but that does keep it simple, right? Just 10%, set up a bank account, set up your bank account, have it automatic direct deposit. And again, kind of like, it's like me with a bag of chips, like Doritos. It's not a plug. They're not paying me, but there's Doritos on the counter. If their bag's open, they're going to get eaten. I'm going to eat them. So,
well, especially if they're nacho cheese flavor. Okay.
Yeah.
They're
and
done.
Yes, absolutely. Yeah. And there's some science on like what they did with the crisp and all that. There's a whole other story about how that Doritos
I don't know.
was founded.
I'm with you though, Jason.
Yeah.
Totally
Yeah. Anyway, but the point is on that, if the money's there, it's going to be spent. So don't have the bag of chips, don't have the Doritos in the first place, and maybe not even have it on the counter, but or don't open the bag.
Don't open it.
I guess the analogy there is those Doritos, don't open with your savings, don't even have the Doritos. So and the point of that is just have your savings go and not be able to be spent. So pay yourself first, get saved, establish that cash reserve. So those some little bit of simplicity. And then the last one in simplicity is once you hit that cash reserve and you have it, raise your deductibles on your auto insurance. You're like, what in the world? Why does that matter? Well, maybe you already have a high deductible. But what we have found is over the years, most people have a low deductible, $250, $500. And, now with rates, claims, you can significantly, again, you got to talk to your property casualty agent. Yeah. But once you have a cash reserve, now you can afford to take that hit should there, unfortunately be an accident. But instead of having a $250 deductible, raise your deductible to $1,000 because you have a cash reserve that can do that. Now your property casualty premiums will go down. Take the difference in premium, take that money and save it for another goal. Maybe it's college education. Maybe put that money in your retirement plan for work. So you're kind of helping insure yourself a little bit. And again, some people raise it higher. I think businesses make more sense there, but you can save a little money there. It might make some sense. So that's just one simplification of having a simple cash reserve and a
Yeah.
401k. I think those, if you have those, if you're doing 10% in both of those, then once you have 3 months worth of living expenses saved, I mean, you're doing better than most Americans. And then you don't have to worry about our next topic, which is the fear of missing out, right? So
FOMO.
yeah. So the FOMO, right? Fear of missing out. Oh, I should buy. How many people listening to this call have just, have a friend or some friend that has told you that Bitcoin is the next deal?
Yep.
That's the recent example. Or, gold is going to go down, oil is going to go up, vice versa. Now, to say this is to not say that I'm anti Bitcoin or anti-gold or anti-oil or any individual stock for that matter. My point is that you can have what most people do. What you don't want to be is the one that just trying to find the next best thing. You're invested, you have a plan, and then say, oh, well, maybe I should take my money out and I should put it in Bitcoin, or I should put it in gold, or I should buy oil, or I should buy
Yeah.
Nvidia stock.
Well, what a contemporary example of that is the meme stock craze, where
All right.
people are like, oh, GameStop, this is GameStop, and everybody starts piling into GameStop. Because why? Because they're afraid of missing out, because they know it has momentum. The problem is that fear of missing out can end really badly.
Yeah.
Um,
In that case, it worked well for some individuals. In that movie
it
that
worked
just
really
came
well,
out.
but unless you were that individual who, like, on the 30th day was like, oh gosh, I'm missing out, I got to buy in on this, and then it didn't work out well for you.
Right. And I think the other that can be said true, this is also the fear of missing out can be more simplified in just saying, you can have it like COVID, right? So COVID
Yeah.
happens, market drops, 30% within a period of time in 2020. And we rally back really quick. That's one of the quickest rallies ever from a S&P 500 standpoint. The
Hmm.
economy, the economy still slowed, but the Wall Street bounced back pretty good there,
Right.
pretty quickly. But just take the picture, go back in time, and imagine it's December of 2022. We were having conversations with individuals about, oh, it's not going to look good next year. I think we should go all the cash, or we should. And I'm like, again, if your financial plan dictates that you stay invested and your goals and objectives haven't changed, you probably should stay invested. But we had some individuals go in cash, and for whatever reason, those individuals missed out on a 26.5% rate of return in 2023 from the S&P
Yeah.
500. So how do you know? I mean, there's no crystal ball. So the fear of missing out, you've just got to, if you stay disciplined, stay invested, I think stay to what, and it also, do you understand it? I think that's my biggest thing with, Bitcoin is, do you understand it? My brother-in-law, I think I remember 2011, sitting in the backyard having a conversation. He's visiting from the East Coast, and he got into Bitcoin, in 2011. I have no idea how well or, how he did there, but, he was talking about it then. And my simple phrase was, if I don't understand it, I'm just going to leave it alone. And, and that's what I did, and not that and of course I look like the goofball because I missed out. Right. But, I'll just go to, I guess it comes from what I learned from, Warren Buffett's probably, one of the best investors of all time. And if you read his material, you invest in what you understand. And
Yeah.
so if you can explain it, it probably makes sense to at least you have a better chance of understanding it. You should be invested in it. If you don't understand it, stay out. And so, again, that's, we would stay with that. So if you understand it, fine, maybe give it some consideration. But if, again, and that just leads me to my next point, is you can avoid the fear of missing out if you stick to your financial plan. And
Yeah.
so
It takes discipline, though. It takes
it
discipline.
does. And and I think I think this is a nice thing to do. It sounds going to sound awkward. But before you make the decision, do this thing called the freeze game, and where you just stop and say, okay, is this stop and just take it all in? And is this decision, why am I making this decision? And just think about then the next question is it in alignment with my with my goals? You know, in behavioral finance, they have something called the alignment model, where you have
Mm,
your goals, you know, you have your values, which are important to you, your goals, of course, which you're striving for, and then you have your actions. And so are your actions what you're taking, this FOMO, you know, is it Bitcoin, gold, is it is it in your is it in alignment? Take a pause, freeze, check that
mm.
out. Alignment with your values, goals, and that's important. You know, we would advocate
What do
for
you
that.
what do you think about the attitude, Jason? You know, that if you have money in your portfolio and you have a really, really bad case of FOMO and you think, I really want to buy this Bitcoin fund. I really want to do that. Is it okay if you allocate a certain amount of money to do that with the understanding that it's a high risk investment? And you know, if you have some degree of consciousness, I guess is what I'm saying.
Yeah, I think that, you know, again, in the past where we've had clients that wanted to do that, we have what's called core opportunity, right? So we have, okay, this is your core portfolio.
Yeah.
And then if you feel like you need to play and do that, then we'll carve out a slice, and, you know, you either trade it on your own at a, you know, trade it on your own, or we work together,
Hmm.
and you make the decisions on that portfolio. But you know, it's just, it is what it is. You know, we had one client years ago make a bet on Apple early in '08, and they've held it all the way, you know, to the top.
Bravo.
And they were really rewarded for that. But that whole conversation came out of a core opportunity. And the question I would say with opportunity is, if you do this portfolio, if you do this slice of your portfolio, if it goes to zero, can you still achieve your financial goals?
Mm,
And if you
mm.
can answer that question and say yes, then I think it's fair enough. If you carve it out and it goes to zero, we all know if it goes up, right? We're happy with that outcome. But if it goes to zero, can you still achieve your financial goals? And if you can't, you probably shouldn't do that much. I'll just say it like that. You know, that's how we have people process the decision. Um, and then the other question that you can kind of throw this, okay, so you do it. Say you put $1,000 in something, um, and it doubles. Uh, is that going to change? You know, are you going to then want to sell after you double? Or are you going to hold? What's your, Buffett's thing is, of course, holding the holding time is forever. So
Yeah.
but are you going to sell it, or are you go, how much, what's in, and then how much is what your what this opportunity portfolio that you're going to do, how much is the result of it? Should it go double or triple? Is it going to change your life? You know, like if it's, you know what I'm saying? Like that.
Yeah, no, I do. Yeah.
And that's where we have that conversation. But I feel like and if someone feels like they just have to scratch that itch, and it's going to zero is not going to impact their financial plan or goals, then have at it. I'd say
Yeah.
go for it. But
Yeah. Interesting.
we're don't operate under the guise of fear of missing out, because you're just never going to be, it's kind of like I used to cycle a lot, and you get your first bike, and then it's carbon fiber, and it's light, and you can pedal, it's got great gears, and it's like, oh, and then you get it. Or golf clubs are the same way, right? There's the new one, you can hit further, all that good stuff, and then you're just like, oh, I just got to get another bike. And at a certain point, you just got to sit there and say, it's not the bike, the same person has to pedal it. I have a friend who's really good on the bike, and he could have an old aluminum bike that weighs 3 times as much as my bike and beat me on the hills, because he's just a better cyclist.
Yeah. Yeah. Exactly.
So
Exactly.
same with golf. There's no, it's yeah, it's the arrow, not the archer, so to speak.
Yep.
Or is the arrow or the archer? You get the idea. In my case, it's the archer with golf clubs. So
Right. No, no.
yeah,
I'm a bad archer with golf clubs, but
yeah, yeah, right. Exactly. So funny enough, but that uh is the example there with, we would want you to, keep it simple. Don't have that fear. I mean, you're going to have that fear of missing out. It's probably a common human nature. But
yeah, no,
when you have that,
it
take
is.
a
Yes.
freeze and just remember, what are my values? What's most important to me? Is it going to get me to or from is it in alignment with my goals? And then, you know, does it make sense? And if you're going to do it, if it goes to zero, is it going to impact your financial plan? So
Good. That's the most important question, actually.
yeah,
That one right there. But if you take a flyer on that and it goes to zero, does it hurt you?
yeah,
Yeah.
yeah.
You know,
So
and with the volatility, you gotta have a strong stomach for this stuff sometimes. Absolutely.
right, right. So yeah, we would
Oh,
say the same. Yeah, don't, you know, and if those Doritos are if you do have them in your house and then you know, the pantry like mine, you know, don't walk by the pantry or move them. Same. So with your investment portfolio, if it works for you to not look at it, then don't look at it. Walk around, do a
It's like
different
just
thing.
don't.
Yeah.
It's not there.
Yeah.
It is not there. Hey, Jason, for those who are listening to this podcast, you're thinking, I like that guy. Maybe I should have a conversation with him. What's the best way for them to get a hold of you?
Yeah. So we offer like a 15-minute phone call where, you know, we have a brief conversation about your questions and see how we might be able to help. You can do that by calling us 559-897-0040.
Mm,
Or you can visit our website, www.coddingtonwealthadvisors.com. We have a ton of resources there. And then on the top right-hand corner, there's a little button where you can schedule that same 15-minute, you know, no cost or obligation conversation and go from there. And then, yeah, that's how you get a hold of us.
that's great. That's great. For those of you who might be driving in the car or listening and not able to write any of this down, I just want to reassure you that Jason's contact information is in the show notes, so you can check it out there when you have the opportunity. Don't worry about it if you can't remember it. It's there. The one thing you might be able to do right now, though, without any interference, is hit the follow button. Subscribe to the podcast. That way, whenever Jason drops a new episode, you'll be notified. You don't have to remember, like, where did I hear this or how often does it come out? Automation, as Jason mentioned, a fact of our life. It's good for you. It'll work in this case.
Yeah, use it to your advantage.
Exactly. If you like the podcast, we'd also say rate it and tell people about it. Let people know what Jason is doing. Word of mouth is always great in helping grow the popularity of a podcast. Until next time, I'm Bill Tucker, and on behalf of Jason Coddington and everybody at Coddington Wealth Management, thank you for taking the time to listen today. And I'm reminding you that you can go out today and make it a great day or not. It is your choice. Thanks for listening. Until next time.